Hey, what's up traders? Hope you're doing well. I hope the markets are treating you well. I am getting married next month, so I have a lot going on my plate right now. And so I've been struggling to keep YouTube content regular. I'm also working on a backtesting course, which has taken up way more time than I expected. There is so much to cover that I've just sort of taken for granted in my subconscious. There's so many things I've learned over the past 8 years of trading that I just don't really consciously think about until it comes to trying to explain it. So it's a really great process. You know what they say, the best way to learn something is to try to teach it. And that is very true, especially if you try to cover the broadest concepts from every trading style I trade, from trend following, mean reversion, swing trading, day trading, intraday trading, relative momentum, rotational trading, which is something I'm going to be talking about today. All weather / tactical asset allocation trading, like ETF rotational systems for low volatility retirement funds. And then you've got high growth systems and potentially automated intraday systems. There's just so much to cover in trading. That's why I think I find it so exciting. Even after 8 years of trading, I'm still passionate about it because it's just such a creative outlet and such a fascinating mental challenge. It's like a puzzle that you never solve, but you get wealthier with every attempt. And I love that. I can't think of something more fun to do with my time. So with the wedding coming up, I've got too much going on to record a video specific for YouTube. So I'm taking some content out of this new course I'm working on, which I don't know when it'll be ready because every time I record a video, it leads on to 5 more that I need to create for context, for sharing tips and techniques that have worked for me, and things I've learned from my trading mentors. But anyway, I'm getting ahead of myself. Huge information dump. Today's video is all about relative momentum. What is it? What makes it special? I love this trading style. It's one of the most low maintenance trading styles. It's the style that I am most heavily overweight in terms of capital allocation. I have well over $200,000 allocated to relative momentum systems, one in the US, one in Australia. It's a very robust form of trading. It's had a fantastic year this year. In fact, it's paid for my wedding and the honeymoon for that matter, the trip overseas to Vietnam, which we're doing later in the year. So I can't speak more highly of relative momentum. So if you're interested, make sure to stick around. Today's video is just a high level overview of what it is, what its strengths and weaknesses are, what are some potential manifestations of it and ways you can apply it, and et cetera, et cetera. And if you're interested in learning how to develop your own systems, sign up to my mailing list or subscribe to the channel, because when this course is ready, and who knows when that'll be, I've already been working on this for nearly a year now, it just keeps growing. But when it's ready, it'll be 100% worth you checking out, because whether you are a new trader, a struggling trader, or just a trader who wants to expand and evolve and absorb information like I do from my mentors and people I find interesting, whose trading styles I like to borrow from and learn from, then make sure to sign up, because I promise you this course will be worth your time when it's ready. With that said, grab a drink, maybe a notepad, take some notes, and I hope you enjoy. None of the material in this video is financial advice. I'm experienced in managing my own finances, but I'm not qualified to give anyone advice on what to buy or sell. You should always do your own research and due diligence before engaging in trading or investing, and please seek professional guidance if you need it. Let's talk about one of my favorite styles of trading and investing, which is relative momentum, or otherwise known as rotational systems. This is one of my favorite styles because it is extremely effective, but extremely simple, low maintenance, very low workload relative to the gains that can be made. When I first learned about this concept, it was very new to me, so maybe it's new to some of you guys. If that is the case, this presentation will help you understand the core concept. Relative momentum, as I said, is one of the simplest and easiest strategies to implement that I've ever seen. It is backed by academic research, which demonstrates that there's an edge in this form of investing as far back as the early 1800s. So it's a very robust form of investing or trading. It's extremely low maintenance and extremely low cost. It's the lowest cost trading system in my portfolio by far. And when I say low cost, I'm talking a few $100s a year in commission costs. Yet I've made, currently, as of middle of 2025, I'm up 40 something thousand dollars on one system alone trading this style. And I've only paid a few $100s in commission costs. So it's a very, very effective form of trading. and I really enjoy it. So relative momentum is different to trend following and other forms of momentum trading in that we are actually comparing momentum relative to the other assets in the universe. So what that means is before you even begin trading a relative momentum system or generating signals to trade, we need to come up with a scoring method or scoring mechanism. So one simple example would be to calculate the rate of change on the closing price on the daily chart over the past 200 bars. Whichever stocks have the highest rate of change over that period get ranked the highest in our ranking method. And then what we do is, let's say we have a portfolio devised of 10 positions. What we would do is rank an entire universe of stocks. So say the Russell 1000, we would rank all 1000 stocks by momentum, by some gauge of momentum, and we would pick the top 10 stocks to hold in our portfolio for the next month, week, quarter. However, we have set up our relative momentum system to trade. Typically, it's a longer time frame. So weekly charts is as low as I would go with this trading system personally. Monthly chart is sort of the sweet spot, but you can go higher. You could even go yearly if you really wanted to. That would probably be best suited to something like an ETF, rotational system, like a super fund type, retirement fund type trading system. But if you're going to do that, then we're moving into tactical asset allocation or all weather systems, which we'll get to in a different section of the course. So for today's example, or concept overview of relative momentum, we are going to focus on mainly monthly examples, monthly time frame examples. And what this means is this trading system is obviously going to be best suited to the stock market. Theoretically, it could be traded on Forex or crypto, maybe commodities, but that is not what it was designed to do. It's designed for the stock market primarily, is where this is most commonly used. And so what we would do is calculate the rate of change over our look back period, rank every stock relative to each other with this scoring mechanism, pick the top 10 stocks, hold those stocks until the next scoring event, which would be end of month, for example. We would re-rank the entire universe of stocks. In most cases, the majority of our positions will still hold, but there may be 2, 3 that have dropped out of the top 10. We would sell those 3 and we would buy the new 3 top 10 rated stocks, and then we would hold them for the next month and so on. We rotate into the top performing stocks based on some objective ranking scoring metric, which is designed to grade momentum. So this is the simplest form of momentum scoring. We can get a little bit more complicated, and I'll show some examples of that later on. Another example of scoring momentum could be the closing price of the previous month divided by its price 12 months ago. So that would give it a yearly price increase. So we could rank all stocks based on how well they've performed over the past year in percentage terms. And finally, one of the more common methods is what is called composite momentum ranking, which is a fancy way for saying merging or combining several look-back periods. So for example, we might give a 50% weighting to the rate of change over the past 12 months, a 30% weighting to the past 6 months, and a 20% rating to the past 3 months. So what this gives us is a total score which is more heavily weighted to the long term. So we've got a 50% allocation to the 12-month look back and a 20% allocation to the previous quarter, 3 months, and 6 months is just thrown in there in the middle. So what we would get is stocks that have performed really well over the past 12 months, past year, and decently in recent time windows would get ranked higher than those who haven't done well over the long term and the medium term. This is a really effective ranking method, and you can obviously get as creative as you want with relative momentum ranking methods within reason. You don't want to curve fit them and have ridiculous amounts of parameters in that. But another example would be, rather than using the rate of change of the closing price, you might use the rate of change of a moving average so that you smooth out any jumps in price. You could penalize high volatility to get lower volatility, high growth stocks. These are just some examples of scoring methods for determining how to rank all of the assets within a universe. So if we've got the Russell 1000 and we can only take 10 positions, we need a way to rank those top 10. These are some examples of how to do that. Step 2 is cross-ranking. So now we need to pick a universe of assets. So S&P 500, Russell 1000, NASDAQ 100. As I said, you could do this on crypto if you wanted to, but the problem with that is we need really to include historical constituents in the backtest to avoid survivorship bias. And the problem with crypto data currently, I haven't personally found a good data source that includes delisted crypto tokens from the past. If any of you find one, please let me know, because that's the missing piece for trading these sorts of systems on crypto. Intraday, totally different story for reasons I've mentioned in the past. On micro time horizons, survivorship bias isn't as much of an issue. And there are other things that are more important, which typically wouldn't matter to a higher time frame system. So that, the context of the trading time window really dictates what matters in terms of biases that we need to be most aware of. For a long-term system like this, historical constituents and survivorship bias is a big deal, especially a system like this. Relative momentum, the idea is to continue to hold stocks which are performing very strongly. If I develop a relative momentum system and I test it on the S&P 500, but I only test it on the current members of the S&P 500, that by definition means I have excluded any stocks which fell out of the S&P 500. And so I would only be testing it on the survivors to the current day. And of course, that's going to perform well. So once we have picked a universe of assets and we have calculated a scoring metric for each asset, the next step is to check the score across all of the included assets and rank these stocks relative to each other. So straight away, this system isn't going to work on TradingView. This is going to be a real test only system, or Amy Broker. There are several other backtesting softwares and trading platforms that you could trade this sort of system on, but I'll be focusing on real test since that's what I use. But I have used Amy Broker in the past to test systems like this, and it worked just fine. And then moving on, as I said, we rank the momentum. So this is a really simple concept. It's not rocket science. We pick a universe, we rank each asset's momentum over some look back period using some sort of custom metric that makes sense to us. That could be rate of change, that could be indicator values, RSI values, etc. Some gauge on momentum. We rank the top X number of assets and we hold those for the next time period until we re-rank them all. Now you might be wondering about stop losses and exit criteria. We don't actually have any for this style of system. One exception is regime filters, which can dramatically improve the risk-adjusted returns of a system like this. I'll go over regime filters in its own presentation because that is a deep dive worthy subject that isn't specific to relative momentum. It works for almost all systems, really. But a regime filter added to a relative momentum system can really step up its performance. But in terms of stop losses, we don't actually use them. We just exit all positions at the end of the month or whatever time period, week, whatever time horizon you choose to rotate on. If the regime filter has failed, we exit all positions, go to cash, and wait for that regime filter to turn back on. Or alternatively, if one or more of our held positions no longer ranks in the top 10 or top X positions, we sell those positions and replace them with ones which are doing better. So we are constantly rotating into the best performing stocks in the market based on some objective measure of momentum. Now, there are some tips and tricks I'll go over when we get into the practical for how we go about doing this. For example, let's say you have a 10 position portfolio. You might not want to sell and replace your positions if they fall out of the top 10 and they fall to 11, 12, etc. Because that can create quite high positional churn. By churn, I mean entering and exiting positions frequently, like at the end of every month. If you exit every position that falls to 11 out of your 10 positions, it's going to increase trade frequency quite a bit, and it might not, and in fact will probably not improve your rate of return or drawdown. It will only increase commission costs, commission drag, without any benefits. So what you can do is have a buffer zone so that maybe you buy the top 10 stocks based on momentum, but you only sell them if they fall out of the top 15 in terms of ranking. And so if your 10th lowest stock falls to rank 15, you sell that and then buy the top 10 stock which you're not currently holding, if that makes sense. We'll get to that in the practical side of implementing this type of system into Realtest. Here is an example in Realtest of what the ranking would look like. So here is my rate of change score in this column, and this is my position ranking. So we have 1, 2, 3, all the way to 10. These are the 10 symbols I would hold for the month. This is the current month of July 2025 as of recording this. I'm not personally trading this system right now. This is just an example template, but this is the concept. So on the 1st of July, I would have run this script. If I was trading it, I would have generated these signals. Let's say I was holding TLS and NHF and not holding LYC and CGF. What I would do is sell these two since they're fallen out of the top 15, and I would buy these two which I'm not currently holding. And the rest of them, if I was already holding them, I would just continue to hold them for the next remainder of the month. And then on the 1st of August, I would rerun my script and repeat the process. And then if my regime filter turns off, and let's say the broad market turns bearish, let's say this is trading the Aussie 100, S&P 100, so the top 100 stocks in Australia by market cap. Let's say if the All Ordinaries, XAO, is trading below its 100-day SMA. Let's say that's my regime filter. If this occurs at the end of the month, then I sell all my open positions, go to cash, and I wait for that broad market to turn bullish again. So that's another important thing to mention. This is a long-only investment system. My research shows there is no benefit in trading this to the short side. It is way better to simply sit in cash, put your cash into a high-interest savings account, wait out the bear market, and then reinvest when your regime filter turns back on. This is the beauty of having multiple systems in your portfolio. There's no need to shoehorn this into a short trading system when that's not what it's designed for. It's designed to capitalize on the sustained bullish momentum of a bull market. You can develop other systems which are designed to profit from bear markets if you desire. For this particular system, it's a long-only bullish market exploiting system. As I said, the secret sauce for this sort of system is the scoring mechanism. How you come up with these numbers will dictate what's special about your system compared to others or other people's relative momentum system. The creativity you put into your scoring mechanism and your regime filter will dictate what stands your system apart from others. So as I mentioned, regime filters deserve their own deep dive, but here are some examples. As I said, the market index could be trading above a long-term moving average. If it's trading below that moving average at the end of the month, you go to cash, avoid the bear market, come back when things are better. You could use a breadth filter, which analyzes the broad market's trend by something like requiring a percentage of the S&P 500 stocks to be trading above their 200-day SMA. You could use a volatility filter, or this in addition to other filters. So the VIX needs to be below a certain number before you will hold for that month. Super trend shows promise, the super trend indicator. If you don't know what that is, do a quick Google, but we'll cover examples of this later on in the course. And I have a link here to Norgate data, which is the data source I would recommend using with Realtest. They actually have a whole web page here, which I'll go to in a second, which details some kind of exotic data sources we have to potentially use as regime filters. So for example, down here in the extras for US stock market, we have things like 52-week new highs and 52-week new lows, or percentage of stocks above their X day moving average. There's a ton. Advanced decline ratio. We have a ton of different options here for all of these indices, which we could use as regime filters. So we can get really creative here with regime filters. Again, you don't want to get too creative. You don't want to curve fit the system. But if you want to do something a bit different to the average person, this is a great place to start experimenting. So here is an example of a regime filter applied to Apple's stock throughout a NASDAQ bear market. So this is on TradingView. You wouldn't trade this system on TradingView, but this is really the best way to visualize this. I've coded up a quick indicator to display the NASDAQ 100's price. Those candles you see in this bottom box is the NASDAQ 100, the index. The blue line is a 200-day moving average, which honestly is probably a bit too long, but it just gave a good way to visualize this regime filter concept. Each light line you see here is the start of a new month. So if you look down here, this is the start of May, June, July, August, September, October, November. Each whitish line you see there is the start of a new month. As you can see, through this period, we had some really strong momentum, bullish momentum on this stock, Apple, back in 2021. So this likely would have been held in a relative momentum system. If you were trading it on the NASDAQ, then it probably almost certainly would have been held for so long as it was highly ranked in momentum. But what happens here on the 1st of February 2022 is our regime filter fails. So the NASDAQ index closes below our moving average here, which is a warning sign that the broad market could be turning bearish. At that time, we were almost at all-time highs on Apple. We're trading up here. So if we're trading a relative momentum system on the NASDAQ with a regime filter like this, we would have exited our positions here and gone to cash, and we would have stayed in cash the whole time this was red, which would have sidestepped a 28% negative correction on this stock. So from where we sold to the low of this correction was a 28% decline. It's tools like this regime filter, which makes it very easy for us as retail traders to beat buy and hold benchmarks and the big multi-billion-dollar pension funds and all of that who are mandated to hold through these periods. We don't have to. If the market's going down, all we need to do is get out of the way. The beauty of this sort of system is it does not depend on prediction. We don't need to predict anything. We just simply hold the best performing stocks until the market turns bearish or that stock is no longer the best performing. It's pretty simple, very powerful trading concept. Now, as I said, this 200-day filter is probably a bit too long. You'd probably want to go with a 100-day, half of this, because we did stay out of the market for literally a full year in this case. But hey, if the market's not making money, why would you be involved in it? So yes, it looks like a long time to stay in cash, but if staying in cash saves you a 30% drawdown, imagine if every stock in your portfolio had a 28% decline over this period or something comparative. What's the point in holding them through this bear market? Just go to cash. You sleep better at night. You can put that money somewhere else, put it into an interest account, and then at the end of each month, you just check your regime filter. If it turns back on, you reinvest your money. If it stays off, you leave your money in an interest account. As traders, our job is to make money. It's not to be right. It's not to be smart. It's not to be active in the markets. It's to make money. And sometimes not trading, not being invested is the best way to make money. There are two ways to make money. You can make profits or you can avoid losses, which in turn makes generating profit a lot easier. A 28% decline in equity requires a 38% gain just to get back to break even. So avoiding big drawdowns is huge when it comes to long-term compounded growth in an investment system. So don't shy away from these regime filters and sitting in cash. I know it's counterintuitive. I know it's hard to do as a trader. Speaking from personal experience, I don't enjoy waking up every day, every week, every month and looking at my charts and saying, oh, I don't have a trade to put on today. That sucks. And having the system lie dormant. But if it makes me money, I will do it. And as I said, there are other ways to make money during a bear market. You could be trading a short trading system. You could be trading other asset classes, Forex, crypto, uncorrelated markets with different trading systems. You need to think of each system in isolation. What are its strengths and weaknesses? This particular relative momentum system's strength is bull markets. Its weakness is sustained bear markets. So we want to stay out of them, which is really easy to do with a regime filter. Moving on, position sizing. So there are quite a few ways we can go about this. The simplest way, which I use, and my trading mentor who taught me this system, Nick Raj, uses, is just a simple portfolio-based split, like I've gone over in previous examples. For example, I have a relative momentum system I trade that has 10 positions at a 10% allocation per position. It's simple, it's robust. I do have less control over risk per trade, but with a relative momentum system trading large cap stocks, that's not as much of an issue. These stocks are very highly correlated, so the stocks tend to perform pretty similarly to each other. But if you really want to get fancy and creative, or you are trading small cap stocks in your portfolio, you could do a method like Andreas Klenau does, using a volatility weighted portfolio. Andreas Klenau has a great book on this called Stocks on the Move. I'll link to this below the video. It's, I would say, required reading for any serious trader. It's a fantastic book. In this book, he goes over a creative method, a highly technical method for volatility weighted portfolio position sizing. So for example, he would calculate the average volatility of each asset in his portfolio, and he would divide his capital up so that he has lighter weight, high volatility assets and heavier weight, low volatility assets. This is the ideal way to trade a system like this. However, it requires quite a bit of capital to be worth the trouble. I'm talking hundreds of thousands of dollars before this would even really make a huge difference to your bottom line and justify the extra workload. It's better suited to hedge funds, proprietary trading funds, rather than retail traders in my experience, just because of the extra workload. The benefits are minimal for a retail trader who doesn't have a huge account. But if you're the type of person who likes this more holistic approach to risk management, there's nothing wrong with it if you come up with a system for doing this, which works for you and isn't too difficult to implement. It can be coded into Realtest. I know Marston has some example template code in the example script section that does demonstrate how to do Andreas Klenau's method directly in Realtest. So maybe we'll go over that in a future practical lesson. But this is something to consider. As I said, Nick Raj has been trading his relative momentum system in the US and the Aussie markets with a 10 position, 10% allocation for a couple of decades now, and he hasn't had any issues. Yeah, the drawdown does get a bit higher than a volatility weighted portfolio would, but the returns are better as well. So it's a double-edged sword. It's kind of like using leverage. Having a more concentrated allocation to each position is very similar to using leverage in the sense that you are amplifying your returns, but you're also amplifying your downside risk, whereas a volatility weighted portfolio dilutes that risk significantly and equalizes each position so that each position has effectively very similar, if not the same, amount of impact on the portfolio's returns or drawdown. And by equalizing your risk across all of the stocks in your portfolio, you smooth out the equity curve a reasonable amount. In my experience, it shouldn't break a system just trading 10 positions at 10% allocation per trade, or some variation of this, 20 positions or 5 positions. 5 positions is getting a bit too concentrated, but it can be done. I'd stick to 10 or more, probably no more than 20, or you'll start to dilute the edge of a relative momentum system. It really, the edge of the relative momentum system is holding those outperformers, the stocks that really carry the index higher. You want to be invested in them, the leaders of the market. The higher your allocation, the more diluted you'll get. You'll start to hold positions which aren't really leading the market. And if you go too small, 5 or less positions, now you're getting a little too speculative and you're sort of putting your eggs in too few baskets. But anyway, we'll go over some examples of these in the practical section. Hopefully this makes sense on a high level concept overview of what relative momentum systems are, what their strengths and weaknesses are, and what they're intended to do. So finally, there's some considerations. As I said, the main consideration is survivorship bias. This trading system style is best applied to the stock market. Be careful if you're trading it on crypto or any other market that does not have good data that includes historical constituents. So for Forex, you could probably get away with it. I'm skeptical it would work because of how choppy the Forex markets are. but maybe it would work. I don't know. I haven't tested it. So I'm not going to say it doesn't work. In theory, it could work if it's designed correctly to behave properly with regards to what makes Forex unique, like the macroeconomic trends and things like that, seasonality, which can impact Forex markets. If you're creative about it, you might be able to get a relative momentum system to work on Forex or even commodities. Relative momentum and trend following have a lot in common. The difference is trend following is absolute. So by that, I mean, you're looking for something like a breakout, and then you'll buy that breakout and trade that higher. For a relative momentum system, you're looking for stocks which have high momentum, and you're trading those outperformers. So their performance is relative to the other members of the index rather than an absolute setup where we're looking at one asset in isolation. We're looking for a particular setup to occur, and we buy that setup or short that setup if it's to the downside. Relative momentum is a little bit different and obviously rotational in nature rather than trading setups. Another consideration is that relative momentum systems typically have low win rates, 50% or less, and they can have a long time to recovery if they get slammed by a bear market like COVID or some rapid crash. Typically, if you're using a robust regime filter, you'll get out of the market when it turns lower, and you'll take a small hit, but you'll be fine. You might stay in cash for a long time though, which means you may take a long time to recover that drawdown, but you'll still outperform the market on average over the long term. That is statistically proven and academically proven by people who have studied and traded relative momentum systems for decades and decades. They do work, but they're a bit slower. They're like the Titanic compared to a speedboat, which would be like a mean reversion system, which is taking trades every day. Maybe the Titanic is a bad example since that's sunk, but you hopefully get what I mean. It's much bigger, slower, longer term, where some other systems are much faster paced. This system, end of month, typically much slower, can take a year or two sometimes to recover a particularly nasty drawdown. However, over a 5+ year time horizon, will almost always outperform buy and hold or passive investment systems. So it's still worth the effort to trade because it's very low maintenance, very low cost, but you need to be aware of the psychological challenges that can come along with this style of system. And finally, the last consideration, which is really like a benefit of this style of trading, is that there's no prediction required. If we have a trend, this system will ride it. If there's no trend, it'll stay in cash. It's very simple. Its edge is very easily explained, which for some people might make it even more comfortable to trade. Anyway, that's all I have to say about relative momentum systems in this particular presentation. When we get into the practical, we'll go over some ranking methods and some portfolio construction methods. Maybe have a quick look at volatility-based weighted portfolio construction as well. Nick Raj has a fantastic 1:15 long presentation on systematic relative momentum trading systems, which I will link below. If you are particularly interested in this investment style, then this video is definitely a must watch. I think you'll find it to be incredibly valuable. The link to this video will be below. So I'll leave you with this, and I'll see you in the next video. Thanks for watching, guys. Appreciate your support on the channel. I'll be back soon with some more content, maybe after the wedding. I'll try to make time to put out some more content before then, but it's hard. If you like this video, subscribe because there's plenty more coming. Good luck with your trading. Hope the markets treat you well. Take care.